Thank you. Gina.
Hi, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about that test for raising interest rates that you just elaborated. You've obviously made it very clear that you want to see improvements in the real economy, in the real data, and not in just sort of expectations data before making that move. But I guess I wonder what happens if inflation expectations were to move up before you see some sort of return to full employment. It seems like a lot of sort of the stability in inflation has been tied to the fact that those have been so low and stable. And I guess I wonder how your reaction would be, or sort of how your reaction to that is how you're thinking about that.
Right. So it seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time. And you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy, which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them, were we to reach that sort of pretty unlikely state.
Thank you.
Chair Powell. I wanted to ask, you've been hearing, of course, these concerns raised by Larry Summers and others about inflation and the fact that they think the Fed might let things get out of hand with the new policy stance. So my question is, can you tell us what is different this time versus previous periods like in the 60s when inflation got out of control? Why are you confident with the lags in monetary policy that the Fed can get ahead of inflation and make sure it doesn't go too far above the 2% target?
Your question. So I actually have a couple of things I'd like to say about inflation, including addressing your question. So let me start with just saying that we're very strongly committed to achieving our objectives of maximum employment and price stability. Our price stability goal is 2% inflation over the longer run, and we believe that having inflation average 2% over time will help anchor long-term inflation expectations at 2%. With inflation having run persistently below 2% for some time, the committee seeks inflation moderately above inflation above 2% for some time. So with a little bit of context, we're making our way through an unprecedented series of events, really, in which a synchronized global shutdown is now giving way to widespread reopening of economies many places around the world. In the United States, fiscal and monetary policy continue to provide strong support. Vaccinations are now widespread, and the economy is beginning to move ahead with real momentum. During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why. But those pressures are likely to be temporary as they are associated with the reopening process. And an episode of one-time price increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation over time. Indeed, it is the Fed's job to make sure that that does not happen. If, contrary to expectations, inflation were to move persistently and materially above 2% in a manner that threatened to move in longer-term inflation expectations materially above 2%, we would use our tools to bring inflation and expectations down to mandate consistent levels. And I would say, if I may, that is a principal difference from, we're all very familiar at the Fed with the history of the 1960s and 70s, of course. And we know that our job is to achieve 2% inflation over time. We're committed to that, and we will use our tools to do that. So that's a very different situation than you had back in the 1960s. There are many, many differences, actually. Let me talk quickly about the two reasons, two or you could say three, but really two main reasons why we think inflation will move up in the near term. The first is the base effects. 12-month measures of inflation are likely to move well above 2% over the next few months as the very low inflation readings recorded in March and April of last year drop out of the calculation. That process has already started to show up. You saw it in the March CPI reading, and you'll see it later this week in the PCE price data. These base effects will contribute about 1 percentage point to headline inflation and about 0.7 of a percentage point to core inflation in April and May. So significant increases, and they'll disappear over the following months. And they'll be transitory. They carry no implication for the rate of inflation in later periods. So that's base effects. The other big one I would talk about is bottlenecks. So this is what we're seeing in supply chains in various industries, and we're in close touch with all of these industries. You know, the Fed has a network of contacts that is unequaled in businesses and in nonprofits for that matter too. So what do we mean by a bottleneck? A bottleneck really is a temporary blockage or restriction in the supply chain for a particular good or goods, something that slows down the process of producing goods and delivering them to the market. We think of bottlenecks as things that in their nature will be resolved as workers and businesses adapt, and we think of them as not calling for a change in monetary policy since they're temporary and expected to resolve themselves. We know that the base effects will disappear in a few months. It's much harder to predict with confidence the amount of time it will take to resolve the bottlenecks, or for that matter, the temporary effects that they will have on prices in the meantime. So, I'll just sum up and say we understand our job. We will do our job, and we are focused, as you've seen, for many years. We've been focused on inflation deviating below 2%, and we used our tools aggressively to keep it back up at 2%. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that. This is not what we expect, but no one should doubt that in the event we would be prepared to use our tools.
Yeah.
Thank you. Jane.
Powell, you said a few weeks ago that it would. Thank you, Chair Powell. You said a few weeks ago that it would take a string of months of job creation of about 1 million to achieve progress towards your goal. Can you define what your definition of a string of months is more specifically? And on inflation, the FOMC said the rise in inflation we're beginning to see largely reflects transitory factors, as you just described. But why use the word largely? And what are the factors driving higher prices that may not be transitory based on the initial data that you're seeing?
So what is a string? What do I mean by a string? Well, I would say what we have right now is one really good. I can tell you what it's not. It's not one really good employment reading, which is what we got in March. We got close to 1 million jobs in March and a very strong labor market reading. And I was just suggesting that we'd want to see more like that. We're 8.5 million jobs below where we were in February of 2020, and that doesn't account for growth in the labor force and growth in the economy, the trend we were on. So we're a long way from our goals, and we don't have to get all the way to our goals to taper asset purchases. We just need to make substantial further progress. It's going to take some time. On largely, there are a bunch of factors. I was really thinking, we were thinking of the base effects and also the energy effects. I wasn't meaning to say there are some real effects. I mean, there are always relative prices going up and down within inflation. There's a basket for CPI or PCE. There are, many factors that go into it. Relative prices are always moving up and down. We think it's very fair to say that the increases we see and frankly are about to see later this week are largely due to base effects. It would have been more contentious to say entirely due to base effects because there are some things that are always going up, and so we just said largely.
Thank you. Michael Derby.
Thank you for taking my question. I wanted to ask you another question about inflation, and it has to do with inflation expectations. A number of different surveys and market indicators are showing, multi-year highs in inflation expectations readings. So I wondered, if that was something that you saw as consistent with your inflation outlook. Is that something that worries you, or do you see that as maybe, the success of the Fed's new inflation framework making it out to the broader public?
Right. Inflation and expectations before the pandemic hit, and here we think of survey, market-based survey being either households or economists and market-based. You look at all of those, and I would say that they were at the low end of what would have been consistent with a 2% inflation target, particularly our 2% inflation target, which calls for 2% average inflation. So they were at the low end. Inflation expectations actually went down a bit at the beginning of the pandemic, and now they've just moved back up to levels broadly that are where they were in 2018 or in some cases 2014. And I would say more consistent with our mandate. And we want them to be. We want them to be higher and on a persistent basis. We want inflation to run a little bit higher than it has been running for the last quarter of a century. We want it to average 2%, not 1.7%. And for that, we need to see inflation expectations that are consistent with that, really well anchored at 2%. We don't really see that yet, but I would say that break-evens have moved up in a way. Break-evens are based on CPI, of course, but they're now at levels that are pretty close to mandate consistent, whereas before they were below. We monitor inflation expectations very, very carefully, as you would obviously know. So that's where I would say it is.
One small follow-up. Do you have any red lines on inflation readings where if you hit like a certain number on, say, core PC, that would be a trigger response from the Fed?
It doesn't work that way. Inflation measures are always going to be a bit volatile. We expect, as I mentioned, we expect core and headline PCE to move up because of base effects. And and we expect that to go away. We also expect these bottleneck effects to come in. We don't know how persistent they'll be. We think they'll, it's a matter of when they will pass through, not whether they will pass through. But we can't be confident about the exact timing of that or the size of them. They don't seem especially large at the moment, but we don't know. I mean, this is all about the reopening of the economy. That's what's happening. We were in a deep hole a year ago, and now with a lot of help from fiscal policy, some additional help from monetary policy, and a great deal of help from vaccination, we're seeing a strong rebound in activity. And what's happening is demand can be spurred with fiscal transfers and the saved up fiscal transfers and people going back to work and things like that. The supply side will take a little bit of time to adapt. New restaurants will have to be opened. The supply of various inputs into the goods part of the economy will have to be brought back up to speed. And you're seeing some of that. That'll happen over a period of time. Over coming quarters, you'll see some of the bottlenecks resolved, but the last one may not be resolved for some time.